Hey guys, this is Tex. I've had some requests to do a basic introduction to options trading, so that's what I want to cover in this video. If you're already familiar with options trading, you might not get much from this video, but hopefully it helps some of you guys out. So I really want to start with the pure basics here because I think there may be some confusion for some of you guys who don't know much about options. The way that I trade options is very different from the way most people trade options. A lot of people use complex strategies like iron condors and vertical spreads, etc. I'm simply buying single leg options on an intraday basis, looking at capitalizing on day trades. Now, when we talk about trading a stock, we know that if we buy shares of a stock, for example, if we buy shares of Amazon at 1770, we are going long. And if Amazon goes up, we make money on that position. If it goes down, we lose money on the position. Likewise, if we short shares of Amazon at 1770 and it goes up, we lose money. If it goes down, we make money. It's very straightforward. And if you're new to trading, I would really recommend that you stick to trading equity because it's very easy to manage your risk. The only thing that impacts the value of your position is the price of the actual stock. With trading options, there are three factors that impact the value of the contracts you're trading, which can make it very difficult to manage your risk. It's definitely a more advanced strategy. So jumping into really just kind of the basics to start with. When you talk about trading options, you are buying contracts. And if you buy, for example, one contract, you are effectively controlling 100 shares of the stock. Okay, so you can see that you're able to control a relatively large position with just one contract. And let's say that that one contract is priced at $1. Whatever the price of the contract is, you have to multiply 100, so that $1 is actually going to take $100 of your capital from your account. And from that, you can actually determine your absolute max loss on a trade. Now, of course, you would never want to lose 100% of your investment, but if you bought one contract at $1, you put up $100 of your actual capital to buy that contract. If that contract expired worthless, you would only lose the $100 that you paid for the contract. No matter if you go long or you go short, the most you can lose is what you paid for the contract. So it's very straightforward in that sense, but it's a little, kind of a little nuance that you have to understand about trading options. You're trading contracts instead of shares. All right, so if you want to go long a stock, you're hedging that the price of the stock is going to go up in value. You're effectively going to buy what are referred to as calls. Okay, so those are contracts that, it's like equivalent to buying shares of the stock. You're hedging the price of the stock is going to go up in value. If you wanted to short a stock, you're going to again buy, but this time what are referred to as puts. So you are buying contracts that will go up in value if the price of the stock goes down in value. So if the stock sells off, the puts will go up in value. If the stock goes higher, if it rips higher, the calls will go up in value. Generally speaking. Now there are other factors involved that we'll get into in just a minute. Now what's really important here is that the contracts that you trade have an expiration date. And so when we're talking about day trading options, I usually trade the current week's expiration date. Now, most stocks have an expiration date, a weekly expiration date that expires at the end of the day on Friday. So, for example, I traded options on Amazon this week. Today is a Wednesday. So I traded contracts that are set to expire on Friday this week. If it is actually the day of expiration, so this Friday, if I wanted to trade options, usually I will actually trade the following week's expiration date just because of the decay factor, which we will also get into in just a minute. You just need to understand that options contracts have an expiration date, and that's very important for you to understand because if you are holding an options contract or options contracts, and they expire worthless, you're going to lose whatever you paid for those contracts. However, if you let those contracts expire in the money, so they're actually worth something, your broker is going to exercise those contracts into shares of the stock. So in this example, if you bought one contract, either a call or a put, if you bought one contract for $1 or $100 of your actual capital, you're controlling 100 shares. So if you let that contract expire in the money, that contract's actually worth something at expiration, your broker is going to exercise that one contract into 100 shares of the stock. Now, that could definitely be a big problem if you don't have enough capital in your account to own 100 shares of the stock. For example, if you buy one contract on Amazon, it's a very high price stock. And so when you let it expire in the money, your broker is going to exercise that into 100 shares of Amazon. And if you don't have enough capital in your account to own 100 shares of Amazon, you're going to get a margin call, and then you're going to have to wire money into your account, and that can certainly create a big problem. Now, for us day trading options, usually it's not a problem. We're not holding positions overnight. We're not holding positions past expiration. So just very important to understand that fact because you could certainly get yourself in a lot of trouble if you were to let that happen. All right. Now, how are options contracts actually priced? And there are three factors. The first is the underlying price of the stock. So again, if you're hedging the price of the stock's going to go up in value, then you buy calls, and theoretically those calls will make you money. If it doesn't work out and the price of the stock goes down, you lose money on the calls. It's the same thing as going long or going short. You're hedging whether the stock price is going to go up or you're going to go down. That is just one factor that's going to impact the value of the contracts that you bought. The second factor is time. Options contracts are a decaying asset. Every minute and every day that passes, they lose value. The closer you get to that expiration date for the options contract that you're holding, the more it's going to lose value. And so that can be kind of something important that you need to consider. There are certain situations, even when you're day trading, that it can be a problem. That time decay can definitely be a problem. The third, and maybe the most important one, is implied volatility. So basically, volatility is one of the big factors for impacting the value of your options contracts. So as you can see, there are three things that will impact the options contract value, and that can definitely make it very difficult to manage your risk. So let me put this to you in kind of practice here. This morning, I was looking at buying some calls on Amazon because I noticed that we had a support level here in pre-market, and we had this gap down from the previous day. So if Amazon came down into this support level here at 1769 and held that, I was looking to go long on Amazon and see if we could get kind of a gap fill up here into this level here, and then maybe even higher. So I was wanting to go long Amazon, so I'm of course going to buy calls. So the first thing that I look at is what is the price of the stock itself where I want to buy those calls. And you can see it's at 1769. So I know I'm going to trade this week's expiration. So the expiration date is already taken care of. We know we're going to trade this week. But I need to choose the appropriate strike price. So you look at your options chain and you'll see a list of strike prices. And this is simply the price of the underlying stock. And since I want to buy calls when Amazon hits 1769 support, I want to buy contracts that are relatively close to that strike price. So if we look at our strike prices, we can see that the ones that are closest is 1767.50 and 1770. For the most part, when you're day trading options, you want to choose a strike price that's as close to in the money or just in the money as you can. And what does that mean? Well, since I'm buying calls, any strike price that is, or since I'm looking to buy calls when Amazon hits 1769, any strike price that is at 1769 or lower is in the money because Amazon is trading above those levels. If I was looking at buying puts, it would be the inverse of that. So with Amazon coming into my support level at 1769, I look at my strike prices around that area. We have 1767.50. That would actually be in the money because that would be just a little bit underneath of the level I'm looking to buy Amazon. The next closest one is 1770, and that is just outside the money. So if I'm looking to buy Amazon right here at the support, I'm actually looking to buy calls either in the money or just outside of the money, but very close. One of the other things that I will pay attention to is the open interest of those strike prices. So if we look at the 1767.50 in the money calls, the open interest is 209. If I look at the next closest strike price that's just outside the money, the 1770 calls, I see the open interest is 1645. All the open interest is telling me is how many contracts are currently open at that strike price and that expiration date. Now, it's not super important, but generally speaking, I like to try to find a strike price that has a relatively high open interest if I can, especially with Amazon, because you can kind of expect that the higher the open interest, the more contracts that are going to be traded. So it's probably going to be a little bit more liquid and the spreads are going to be theoretically a little bit tighter. Now, this isn't always a problem with some stocks that are very, very liquid, but Amazon in particular is known for having wide spreads. So it's just a practice that I tend to implement whenever I'm looking at choosing the appropriate strike price. So for the trade that I actually took today, I chose the 1770 calls because I was looking at going long into the 1769 support. So it was close enough to end the money, and it also had a very high open interest. So most likely it was going to be a lot more liquid and tighter spreads for the most part. Not always the case, but generally speaking. So the most important takeaway here is you don't want to choose a strike price that's too far out of the money, and you probably don't want to choose something that's like really far in the money. So it's kind of like a sweet spot, if you will, choosing a strike price that's very close to in the money or just barely in the money so that you can really kind of maximize your return, but also minimize your risk. If I were to choose a strike price, for example, like way up here at 1777 is the furthest away I can see. So if I choose the 1777.50 call, that is, that's outside of the money. That is 1777.50 is going to be like up here in this area, somewhere right up in here. That's a long ways out of the money. When I'm looking to buy calls when Amazon is actually here, I don't want a strike price that's that far away. Now, if you choose a strike price that's really far out of the money and Amazon actually makes that move up to that strike price, you're probably going to get a pretty big percentage return on your money. But if it doesn't work, if Amazon actually, in this case, Amazon ended up selling off, as you can see, you're probably going to end up losing more money because the price of the underlying is going to move even further away from the strike price that you chose. That's why it is kind of important to choose a strike price that's very close to in the money or just inside the money in order to kind of minimize your risk, but also maximize your return on the trade. So pretty straightforward. I mean, I chose the 1770 calls. I bought it into support. And I sold some of my position when it came up on this kind of quick move up here. When it failed to get the follow through I was looking for, I ended up taking the rest of the position off and just didn't get as big of a return as I would have if the trade had got the follow through and got the gap fill and so on. So the underlying price of the stock was very important to consider because it meant that the calls that I bought increased in value when Amazon did start to work, but just didn't get the follow through, so I didn't get a very big return on the trade. Time is also something important to consider when you're day trading options, because if you were to, for example, buy those calls like I did, you buy the 1770 calls, and then let's say that Amazon just kind of trades sideways for a long period of time. It just kind of sits here and consolidates, and it really hasn't gone anywhere. The underlying price of the stock is still trading right there around the same price it was when you bought those calls. Well, because of that time decay factor, those calls would actually lose value as time passed, even though the underlying price of the stock really hasn't changed much. So that can definitely make it a little bit difficult. If I were to buy shares of Amazon on the equity side, it could sit here and consolidate forever. I would still basically be flat on the position because it is only your shares on the equity side is only impacted by the price of the stock itself, where options with that time decay factor, you can actually lose money on your position, even though it's just sitting there consolidating. So that's something to consider. The other thing, like I said, is if you're trading options very close to expiration date, or even worse, on the day of expiration, that time decay factor is magnified greatly, and your losses can be can really be magnified. You can, you can really end up losing a lot more than you really want to because of the time decay factor occurring on the day of expiration. And then the last thing that you really need to understand is implied volatility. So the more volatile that the stock is, generally speaking, the more return or the more loss you can expect on your position. So a good example is what happened here on Amazon. Let me draw this out. So right here in the afternoon on Amazon, it had this huge liquidation break, this absolute huge volatile sell-off. All right, so let's say that you were actually, you bought some calls, you see this higher low right here, after it put in this low over support here, comes back, puts in a higher low, looks like it might be reversing and going to go higher. So let's say you bought calls right there looking for a reversal move on Amazon. And then out of nowhere, you get this huge volatile sell-off. Well, because of the volatility of that sell-off, those calls that you bought will decrease in value dramatically and very quickly. So you can end up in a situation where you lose a lot more than you really intended to because all of a sudden a huge amount of volatility hit, which dramatically impacted the price or the value of those options contracts. The same goes in inverse though. So if you were actually holding puts and you got that huge liquidation break, the value of your puts would explode in value and you can get absolutely huge returns. That's when you get home run trades in options, is when you are on the right side of a trade when big volatility hits like that. You can often get 100, 200, 300% return. Well, I wouldn't say often, but it's possible to get multiple 100% return on your position when a lot of volatility hits and you're on the right side of the trade. But on average, I would say, don't expect more than about a 30% return on average. Sure, there are home run trades where I've gotten, I think, a 300% return on one trade. So a 300% return on the investment or the money that I paid for those contracts is absolutely incredible. But when you think about it in terms of just an average return of 30% on any one trade, that's fantastic. A 30% return on one trade is really, really good. So like I said, on average, you should be aiming for about a 30% return on your options trades, which is a great way to get a nice return compared to trading the equity in a lot of cases. So I think I covered pretty much everything that I needed to discuss with you guys. The most important takeaway, like I said, is that trading options can be very difficult because of those three factors that affect the value of those options contracts. So it's something that you definitely need to kind of keep in mind. And I think you can understand that it's definitely a more advanced instrument to be trading because of that. So you just need to understand the risk associated with it and the kind of position that you're actually controlling. One contract is equivalent to 100 shares of the stock. So you can make and lose a lot of money by trading options. So it's very important that you understand the risk associated with that before you ever, really try to trade them live. I would recommend actually paper trading options to kind of get a feel for how they move, for how the value of those options contracts will fluctuate during a trade. It's very important to kind of see that because it will be very surprising to you to see how your P&L swings really move around in an options trade compared to an equity trade. All right, guys. So if you have any questions or comments, feel free to leave them below. Let me know how I did on the video. If you found it helpful, I always appreciate that. And like I said, if you do have any questions about maybe something I didn't address clearly or that I missed, I'll be happy to answer those in the comments below. And also do me a favor, please do hit that like button, subscribe for more content like this in the future. And I always appreciate it. Take care, guys, and I will catch you in the next video. See ya.